Understanding price action trading. Price action trading is based on the belief that all relevant market information is reflected in the price itself. It relies on the analysis of historical price data, such as candlestick charts, to predict future price movements. By observing patterns and formations on charts, traders can gain insights into market sentiment and the balance between buyers and sellers. Price action trading and trading with indicators are two distinct approaches to analyzing financial markets. Here are the key differences between the two. Focus. Price action trading focuses solely on analyzing the price movement and patterns displayed on price charts. Traders who use price action rely on observing the actual price levels, candlestick formations, and chart patterns to make trading decisions. They believe that all relevant information is already reflected in the price itself. On the other hand, indicator-based trading involves using technical indicators, such as moving averages, oscillators, for example, RSI, MACD, and volume indicators, to generate trading signals. These indicators are mathematical calculations based on price and/or volume data. Traders using indicators believe that these tools provide additional insights into market conditions and help identify potential trading opportunities. Complexity. Price action trading is often considered simpler and more straightforward compared to trading with indicators. Price action traders rely on their ability to interpret and understand the price patterns, support and resistance levels, and candlestick formations. They develop a deep understanding of market dynamics through observation and analysis of historical price data. Indicator-based trading can be more complex as it involves using multiple indicators with different settings and parameters. Traders need to understand how each indicator works, interpret the signals generated, and determine how they align with other indicators or market conditions. This complexity can sometimes lead to confusion or conflicting signals. Lagging versus leading. Indicators are typically considered lagging indicators because they are based on past price data and provide signals after the fact. They are calculated using mathematical formulas that require historical data to generate signals. Therefore, indicators may not respond quickly to rapid market changes or sudden price movements. Price action analysis, on the other hand, is considered a leading approach. Traders observe the current price action and patterns as they unfold in real time. This allows them to react more quickly to changes in market sentiment and potentially identify emerging trends or reversals before indicators catch up. Personal interpretation. Price action trading often involves a higher degree of subjective interpretation. Traders develop their own understanding of price patterns and market behavior through experience and observation. This subjectivity can lead to variations in how different traders interpret and trade based on price action signals. Indicator-based trading, on the other hand, is more rule-based and objective. Traders use predefined criteria and specific indicator signals to make trading decisions. The interpretation of indicator signals is more standardized and less open to individual discretion. Key principles of price action trading. Candlestick analysis. Candlestick charts are at the heart of price action trading. Traders closely observe the shapes, colors, and patterns formed by individual candlesticks, as well as their interactions with previous candles. Common candlestick patterns include doji, engulfing patterns, and hammers, which provide valuable indications of potential market reversals or continuations. Support and resistance. Price action traders pay significant attention to support and resistance levels. Support represents a price level where buying pressure is expected to increase, preventing further downward movement. Resistance, on the other hand, is a price level where selling pressure is anticipated to intensify, hindering further upward movement. These levels serve as potential entry or exit points for trades. Trend analysis. Price action traders analyze trends to identify the overall direction of a market. Trends can be bullish, upward, bearish, downward, or range-bound, sideways. Trend lines, which connect consecutive swing highs or lows, are useful tools for visualizing and validating trends. Price action trading techniques. Breakouts. Traders watch for breakouts above resistance or below support levels. A breakout occurs when price moves beyond a significant price barrier, indicating a potential shift in market sentiment. Breakouts can lead to substantial price moves and offer opportunities for traders to enter or exit trades. Pullbacks refer to temporary reversals within an ongoing trend. Price action traders often wait for a pullback to key support or resistance levels before entering trades in the direction of the overall trend. This technique allows traders to enter at better prices and reduces the risk of trading against the prevailing market sentiment. Engulfing patterns occur when a candlestick engulfs the body of the previous candlestick, indicating a potential reversal in the market. A bullish engulfing pattern occurs in a downtrend and suggests a shift towards bullish sentiment, while a bearish engulfing pattern occurs in an uptrend and indicates a potential bearish reversal. Advantages of price action trading. Simplicity. Price action trading relies on reading and interpreting price charts, making it a straightforward and easy to understand strategy. It eliminates the complexities of relying on numerous indicators, allowing traders to focus on the essentials. Adaptability. Price action trading can be applied to any financial market, such as stocks, forex, commodities, and cryptocurrencies. The principles and techniques remain the same across different markets, providing traders with a versatile approach. Risk management. Price action trading techniques, such as using support and resistance levels, allow traders to define clear stop-loss levels and calculate risk-reward ratios. This emphasis on risk management helps traders protect their capital and limit potential losses. Conclusion. Price action trading offers a disciplined and logical approach to analyzing financial markets. By focusing on price movements, patterns, and key levels, traders can gain valuable insights into market dynamics and make informed trading decisions.